Hi, I'm Dominic Picardi here for the 2014 New Year edition of Spreadbet magazine, and today I'm looking at when we might expect a reversal in the price of gold. Now, the yellow metal has, of course, been in a really strong downtrend since its all-time nominal traded highs back here in the September of 2011. Now, given the sort of extent of this decline and given how long it's been going on for, a lot of people, quite understandably, think that the boom of the previous dozen years or so into those highs above $1,900. They believe that long-term uptrend is now at an end, and that the long-term trend in gold is now downwards one more, and that is somewhat understandable because investors are no longer worried about the imminent collapse of the US dollar, nor about the Eurozone disintegrating, nor about inflation resulting from easy money policies. At the moment, this is a sort of Goldilocks situation. Everything's okay. People have lost their fear a bit, and as a result, they're switching funds away from safe haven assets like gold and sticking it into what's doing well and what they think is going to continue to do well, being the stock market in particular. But my longer term outlook for gold remains very favourable. I don't see the underlying problems that triggered the crisis of over indebtedness as having gone away. And in fact, I think that the way that the authorities are going to deal with that, and they're going to have to deal with that in the years ahead, is by pushing borrowing costs to below the rate of inflation, as the US has been doing much of the dozen years or so before, back to the early 2000s. And that is really the key to gold's price performance. When the price of when interest rates adjusted for inflation go downwards, the price of gold tends to go upwards, and when the real price of money tightens, gold tends to struggle, and that's what's been happening in this year particularly. But I think this process will be reversed in due course. I don't see a credible alternative to that. And this decline that we've seen here, while it may feel terminal to many people, it is entirely consistent with what went on, say, in the 1970s, as I've argued before, where halfway through the bull market in gold, the price suffers a terrible 50% correction and then starts moving again. And I think that's what's going to happen this time round. When this shakeout is finished, and it could take it down to $1,000 or something like that quite easily. But when that process is over, I think then gold will go ballistic, and eventually we will see gold well through these highs up here, and through all-time real highs, so closer to 3,000 and probably above. But that's a story for another day. At the moment, my concern is not to buy a falling knife. I mean, clearly the correct trade for most of the time here has been shorting the end of rallies, but I'm also looking. I think now in particular, because of the state of negative sentiment in gold, and because the positioning of traders, of futures traders, has become the smart money is tending to get behind gold, I would be particularly keen on buying the next rally. So what I've done is I've looked for a back-tested strategy that would have made money buying gold even during this downtrend, and I want to go long on the next of those signals. And I found it a very, very simple approach of buying when the shorter of the two moving averages you can see here, being the red line, which is the 9-day exponential moving average, has crossed above the other line, the purple 11-day moving average. This would have been a profitable strategy. To be precise, this strategy, assuming sort of a simple $1 profit per $1 position, you'd have made $177 of profit on the way down, whereas buying and holding since September 2011 or so, early in 2011, you'd have made a loss of over $200. So in that, you'd have had 9 losing trades and 4 winners, but the risk reward ratio would have been fairly favourable, 4-1. So that means that the overall strategy made money during that time. So what would get me interested in gold again as a crossover of the 9 and 11-day moving averages, and then that's the time at which I would go long. And then you can either take profits discretionarily after that, according to when you think the move is ending, or you can take the orthodox approach, which is just to wait until the signal gets reversed. But that will be my approach for trying to make money out of the next big rally in gold, and there probably will be one coming, even if the overall bear market isn't yet over.